In this video, we are reviewing the study guide, the primary study guide for Exam 1. This is video 1 of 4. It will cover the Chapter 12 conceptual material on pages 1 to 4 of the primary Exam 1 study guide. First, we talk about Chapter 12, Statement of Cash Flows. This exam will only cover Chapter 12 and 14. Point allocation is split 50-50 with 50 points for Chapter 12, 10 points of which come from multiple choice. You have 5 multiple choice questions at 2 points each for Chapter 12, and a written question worth 40 points. Things you want to be able to do. You want to be able to identify examples of non-cash investing and financing activities. You want to be able to complete a full statement of cash flows. You want to know what types of accounts are included in each of these subsections, operating, investing, and financing. Additionally, you want to be able to define the statement of cash flows. So what does the statement of cash flows report? What is the statement of cash flows? It is a report of cash in and cash out during an accounting period. It describes how cash changed from the beginning to the end, and it classifies cash flows in 3 categories: operating, investing, and financing. But it is a report that captures how cash was received, how cash was spent, so cash flows. And by cash flows, in this context, cash for the statement of cash flows equals both cash and those things that are essentially the same as cash equivalents. 3 primary sections: operating, investing, and financing. Let's talk about the structure of the statement of cash flow to get a good foundation for how you should approach this. The first section is the operating section. Immediately after that label, the very first thing you report is net income. Then you make 2 types of adjustments. You're starting with the income statement. You first get the bottom line, net income, and then you adjust for non-cash income items. And by adjust, we mean you want to reverse their effect on net income. Non-cash income items that we're concerned with are depreciation expense and any kind of gain or loss. You're reversing their effect. So think first about what they do to net income. An expense reduces net income, so to reverse, I need to increase or add back. Losses are very much like expenses in their effect. They reduce net income, so to reverse, I add back. Gains function very much like revenues, which means they increase net income, so to reverse, I need to decrease or subtract. So I've now taken into account my non-cash income items, which include depreciation expense and any gain or loss. After that, I'm finished with the income statement, and I now focus on the balance sheet. I want to adjust for changes in any of the current accounts, current assets, and or current liabilities. So current assets, why would a common current asset like account receivable, why would that decrease? So account receivable reflects the money that customers owe me. Why would I say they owe me less? So account receivable would go down. I would say they owe me less when they pay me, when I get money from them, or when my cash increases because I receive cash from my customer. So account receivable going down, cash going up, opposite effect. That means it's an inverse relationship. So an increase would correspond to a decrease. A decrease, I expect to correspond to an increase. Accounts payable, on the other hand, the amount that I owe my vendor on credit. Accounts payable would decrease when I pay the vendor what I owe them. So accounts payable is decreasing and I'm paying cash. So my cash is decreasing as well. Decreases correspond to decreases for current liabilities. That is a direct relationship. So an increase, I expect, will correspond to an increase, a decrease to a decrease. After taking into account all the current asset and current liability changes, I then sum up all the operating cash flows, getting cash provided or used if negative, and then I go to the next section, investing. It's always in the order of OIF, operating, investing, financing. Investing, so if you had a balance sheet, you've got current assets, long-term assets, current liabilities, long-term liabilities, and then equity. I took care of current assets and current liabilities in operating. Then I've got long-term assets next. That's going to be investing. And these last two things over here, the last two things on the balance sheet would be financing. So they follow the order of the statement of cash flows. So investing is concerned with long-term assets. I use the balance sheet to identify what long-term asset accounts I have. Then I look for information about cash transactions related to long-term assets. I look for that in additional info. Then I sum them up, cash provided or used by investing. And then finally, the last section, financing. It's worried with the last two accounts on the balance sheet, long-term liabilities and equities. Same approach here. Use the balance sheet to identify relevant long-term liability and equity accounts, and then look to additional info for info about cash transactions relating to those accounts. Then sum up all your financing activity cash flows to get cash provided or used by financing. Okay. Also, you want to be able to identify examples like multiple choice type questions, identify examples of non-cash investing and financing. Pay attention to the label itself. It's non-cash, meaning I should not be seeing cash change. Any kind of cash transaction or cash exchange would mean it's not a non-cash. Investing and or financing related means it should involve long-term asset, long-term liability, or equity accounts. So here, using a note payable, which is a long-term liability, to finance equipment, a long-term asset in that year. So there's no cash changing hands. So that is in investing, financing, non-cash investing or financing. Using common stock, that's an equity, so it's financing related. To purchase equipment, long-term asset, that's investing related. I did not exchange cash again, so that's non-cash investing or financing. Paying off a note payable, a long-term liability by issuing common stock and equity. Both of those are financing related. There's no changing cash or no exchanging cash. So even though both of them are financing, they don't actually have to be both investing and financing. They can be both financing related. That's perfectly fine. Or both investing related. That would be fine. But it involves no cash and long-term asset, long-term liability, and or equity accounts. That's non-cash investing and financing. If I use cash in the transaction, it cannot be non-cash by definition. Additionally, it cannot involve operating activities. So that means no expenses, revenues, gains, losses, no current assets or current liability accounts. Okay, let's do another summary sheet for those sections. I start with the operating section. I first report net income, then adjust non-cash income items, depreciation expense, and any gain or loss. Then I adjust for changes in current assets and current liabilities. Current assets have an inverse relationship with cash. So an increase in a current asset should have the opposite effect on cash. So decrease. A decrease should correspond to an increase. Current liabilities have a direct relationship. So increases correspond to increases, decreases to decreases. Second section is investing. My focus here is long-term asset accounts. Last section is financing, focusing on the last two types of accounts on the balance sheet, long-term liabilities and equities. Okay, that is the end of video 1. We'll pick back up in video 2 with the chapter 12 problem on page 5 to 6.